Welcome to today's Explainer. We're breaking down the absolute blowout Q1 2026 earnings from ROST stores, along with a pretty bold strategic shift they just announced. I mean, if you follow the retail sector at all, you know it is a notoriously tough environment out there right now. But ROST? They just posted numbers that literally made the entire market do a double take. So let's dig right into their recent financial filings, earnings calls, and strategic reports to see exactly how they pulled this off.
Okay, let's jump straight to the massive headline number. We're talking about a staggering 21% increase in sales, which brings their first quarter 2026 revenue up to $6 billion. But honestly, what really anchors this whole achievement is the highly robust 17% comparable store sales growth right out of the gate. This wasn't just a matter of opening up a bunch of new locations. This was driven by significantly more people walking into their existing stores and just buying more stuff.
Now, before we get too deep into the current quarter, let's zoom out and look at the bigger picture. Their historical total return over the last 5 years consistently outperforms both the broader market, the S&P 500 index, and their direct peers in the Dow Jones Apparel Retailers Index. So the takeaway here is that they have a proven playbook, and today we're going to discover exactly how they are running that playbook at such an elite level. To help make sense of all these dense filings, here's our roadmap for the explainer. First, Q1 2026. Crushing expectations. Second, winning the off-price market. Third, AI and supply chain investments. Fourth, navigating macroeconomic risks. And fifth, rewarding the shareholders. Let's get into it.
Part 1, Crushing Expectations.
So, looking at the numbers, that incredible top-line revenue trickles all the way down to profitability. Their operating margin actually expanded by 120 basis points, or 1.2%, to 13.4%. And let me tell you, that is exceptionally hard to do in retail right now. Net income jumped from $479 million to $650 million, which pushed earnings per share up a crazy 37% to $2.02. Management pointed out that this was driven by strong comparable store sales leverage and lower domestic freight costs. Basically, those savings effectively absorbed the higher store payroll expenses they had to take on just to handle the massive increase in product flow.
Moving to part 2, winning the off-price market.
So you're probably wondering, how exactly is ROST generating this kind of explosive top-line growth while traditional department stores are practically begging for foot traffic? Well, the secret sauce is their core treasure hunt experience. They aren't just selling clothes, they're selling the thrill of the deal. They rely really heavily on opportunistic buying, snapping up closeout merchandise from vendors at steep discounts and then turning that inventory over constantly. What the earnings call revealed is that this specific strategy is driving double-digit increases in customer counts across literally all income levels and ethnicities. And maybe the most fascinating part? They noted particular strength among younger 18 to 24-year-old shoppers. Gen Z is totally leaning into the treasure hunt.
Now, a super crucial part of this off-price model is something called pack-away inventory. Basically, this is when ROST buys excess high-quality goods at a massive discount, but instead of putting it immediately on the shelves, they stash it in warehouses to release later during the proper season. Pack-away inventory made up 36% of their total inventory this quarter. While that is down a bit from 41% last year, it remains an absolutely massive strategic lever that lets them continuously offer fresh, compelling bargains to their shoppers all year round.
Part 3, AI and supply chain investments.
With demand surging at this kind of pace, ROST is actively future-proofing its operations to make sure they can keep the shelves stocked and the goods moving. And there's this really revealing statement from the recent earnings call from CEO James Conroy that perfectly captures their pivot. Coming out of a highly risk-averse, kind of defensive posture during the post-pandemic crunch, management has deliberately shifted the corporate culture toward offense. They are empowering their buyers and looking really aggressively at market expansion.
But of course, you don't get to play offense for free, right? Their projected capital expenditure is ramping up from $819 million in fiscal 2025 to a massive projected $1.1 billion in fiscal 2026. This isn't just a slight budget tweak. This is a huge capital commitment to scaling up their infrastructure.
So where exactly is $1 billion going? This huge CapEx budget is funding the integration of artificial intelligence, automation, and data-driven systems right into their supply chain. For example, they're building a highly automated, state-of-the-art distribution center in Randleman, North Carolina. And all of these tech investments are explicitly designed to handle the logistical load of the 110 new stores they're opening up this year alone. They have to make sure that the treasure hunt never runs out of actual treasure.
Part 4, Navigating Macroeconomic Risks.
It's not all just clear skies, though. Management is currently performing a really delicate balancing act. On one hand, you have these incredible tailwinds. They've confidently raised their full-year earnings per share guidance to between $7.50 and $7.74, mostly fueled by an outstanding availability of market closeouts. But countering that, there are very real headwinds. The company is actively warning us about elevated fuel and freight costs eating into their margins, potential uncertainties around international tariffs, and a consumer base that honestly remains pretty cautious due to lingering inflation. It's a real tug-of-war.
So how are they fighting those macroeconomic headwinds? Well, one big way is by relentlessly improving their merchandise margin. Now, this is a super vital retail metric. It represents the gross profit strictly from the products themselves before you even factor in warehouse or real estate costs. Impressively, ROST expanded their merchandise margin by 85 basis points this quarter. They pulled this off through excellent opportunistic buying and a highly favorable product mix. In short, they're just buying a lot smarter.
And finally, Part 5, rewarding the shareholders.
Ultimately, all of this operational success generates massive amounts of cash. I mean, in just the first quarter alone, ROST generated $836 million in operating cash flow. This absolute river of cash easily funded over $143 million in dividend payments, which sits at a very solid 0.4450 per share quarterly, by the way, and it allowed them to repurchase nearly $319 million of their own stock.
And they are definitely not slowing down. The board just approved a massive new 2-year, $2.55 billion stock repurchase program. For this fiscal year alone, they are explicitly targeting over $1.2 billion in buybacks. It's a very clear signal from management that they believe their own stock is a prime investment, driven by all the strong fundamentals we've just mapped out.
So, to wrap up our explainer today, we really have to look to the future. They've shifted their whole corporate culture to offense. They're pouring over $1 billion into AI optimization and physical expansion. But here's the big question you should take away from all this. As inflation lingers and the broader consumer economy faces potential turbulence, can ROST stores actually keep crushing expectations? Or will those macroeconomic headwinds ultimately slow down the treasure hunt? It's a fascinating dynamic, and we are absolutely going to be watching it closely. Thank you so much for joining me, and keep learning.